Most people are misreading XRP right now. The institutional case for the XRP ledger may have far less to do with transaction speed and much more to do with a financial problem Wall Street has spent decades paying to manage. In the next few minutes, we're breaking down David Schwartz's auditability argument, why tokenized assets could be the biggest story, and what institutional adoption actually looks like beneath the headlines. Because here's the part most people miss. When a financial institution is audited, proving what exists is relatively straightforward. Proving that a hidden obligation doesn't exist somewhere else is much harder. Traditional finance built layers of intermediaries, reporting systems, and third-party verification around that problem. And those layers cost a lot of money. Schwartz's argument is that a transparent blockchain can fundamentally change that equation. And that's why his prediction of hundreds of billions of dollars in tokenized assets on the XRP ledger deserves a much closer look. Ladies and gentlemen, if you want the satellite perspective on XRP and crypto and want to cut through the daily chaos and noise, subscribe to the channel. I break it down simply so you can see what actually matters in the market. Thank you always to everyone who likes and shares each of our videos. These two things really do help out the channel. Imagine you're an auditor reviewing a large financial institution. The company gives you its records. You examine those records. Everything appears clean. The balances reconcile. The transactions appear legitimate. The documentation is complete. But there is a fundamental problem. How do you prove that there isn't another obligation somewhere else that wasn't included in the information you were given? You can verify what you've been shown, but proving that something doesn't exist is much harder. That's the basic idea behind Schwartz's described as the proof of absence problem. Traditional finance has developed layers of infrastructure to deal with this. Third parties, clearing systems, custodians, transaction operators, reconciliation systems, auditors, periodic reporting, and institutional reputations. These systems aren't necessarily inefficient because everyone involved is incompetent. They're inefficient because they're solving a very difficult information problem. You have different organizations holding different pieces of the financial picture. So you need trusted intermediaries to verify those pieces. And that comes at a cost. We just saw how dangerous opaque financial exposures could become during the 2008 financial crisis. One of the defining problems was not simply that individual mortgages went bad. It was that financial institutions had difficulty understanding the full chain of exposures connected to increasingly complicated structured products. The system contained layers upon layers of obligation. Who owned what? Who was exposed to whom? What collateral actually existed? Blah, 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 blah. And what would happen if another institution failed? The crisis demonstrated something fundamental about modern finance. Complexity creates information risk. And when information becomes fragmented across institutions, proving the true state of the system becomes much harder. Blockchain doesn't magically eliminate financial risk now. It doesn't prevent bad investments. It doesn't stop people from making mistakes. But a properly designed distributed ledger can create something traditional databases often struggle to provide across organizational boundaries. A shared, continuous, verifiable record. Let that sink in. That's the distinction. Now here's where it gets interesting. If a financial institution can continuously inspect a shared ledger and determine the state of its positions without having to repeatedly ask another organization for confirmation, you've changed the economics of verification. The auditor doesn't necessarily need to depend on a periodic snapshot. The institution can have a much more continuous view. That could reduce reconciliation. It could reduce duplication. It could reduce certain administrative costs. And it could make financial reporting more transparent. This is why I think the phrase blockchain is faster actually undersells the institutional opportunity. Speed is visible. Auditability is structural. Speed makes a transaction feel better. Auditability can potentially change the architecture underneath the transaction. And that's a much bigger deal. Let that sink in, ladies and gentlemen. That is where Schwartz's comments at Apex become especially important. Schwartz was discussing what he expects to see many hundreds of billions of dollars of tokenized assets on the XRP ledger. And he describes that happening fairly quickly. And when asked why, The answer was essentially audibility. He even characterized the reason as somewhat boring. And honestly, that's exactly what it makes it interesting, because institutional adoption isn't necessarily going to be driven by what sounds exciting to retail investors. No, not at all. It could be driven by things most people never put in a thumbnail: reconciliation, reporting, audit trails, settlement finality, operation efficiency, risk controls. Don't those things make you excited? Those are the things that determine whether a bank's legal department will approve a system. That makes me excited. And if blockchain infrastructure can remove expensive layers from the process, institutions have an economic reason to investigate it. I want you to think about the railroads. The important innovation wasn't simply that a train could move faster than a horse. No. The railroad changed the architecture of transportation. It changed where cities developed. It changed supply chains. It changed the economics of distance. In the same way, blockchain's biggest institutional contribution may not be that a payment settles in a few seconds instead of several days. The bigger change could be that the underlying financial records become shared continuously, verifiable infrastructure. The transaction is only one part. The record itself becomes infrastructure. And that's the distinction most people miss. Now let's talk about the XRP ledger itself. The design philosophy is important. The base ledger is deliberately focused. It isn't trying to become every possible computing environment. That matters because institutional infrastructure has different priorities from speculative applications. A bank doesn't necessarily want unlimited complexity sitting underneath its core settlement system. No. It wants predictability. It wants known behavior. It wants defined transaction costs. It needs security and wants security. It wants systems that can be monitored. And it wants fewer unknown variables. That's one reason the argument around smart contracts needs to be handled very carefully, ladies and gentlemen. Write that down and let that sink in. The fact that the XRP ledger base layer isn't designed like a general purpose smart contract platform isn't automatically a weakness. No. It can also be integrated as a design choice. Additional functionality can exist through other layers and systems while the core ledger remains focused on settlement and asset movement. That's a different philosophy from trying to put everything directly onto the base layer. And for institutional finance, simplicity can be a feature. Here's the part I really want you to understand, ladies and gentlemen. Institutions don't necessarily need the most complicated blockchain. They may need the most predictable blockchain. There's a huge difference. Retail investors often look at blockchain technology through the lens of features. How many transactions per second? How many applications? How many tokens? How many smart contracts? How many developers? Institutions can look at the exact opposite question. How do we audit it? How do we control risk? How do we reconcile balances? How do we prove ownership? How do we integrate custody? How do regulators inspect it? How do we explain it to our lawyers? God, I know that question. How do we know what happens without asking 5 different organizations? That's where the institutional blockchain debate becomes much more interesting. And this isn't happening entirely in theory, ladies and gentlemen. Avia Investors, the global asset management businesses Avia, announced a partnership with Ripple in February 2026. Explore tokenization of traditional fund structure on the XRP ledger. Then in July, Avia Investors announced the successful launch of a tokenized shared class of its US dollar liquidity fund on the XRP ledger. That matters because we're moving from let's explore tokenization to let's actually issue a financial product in tokenized form. That's an important distinction, and we need to be precise. It does not mean hundreds of billions of dollars have already migrated onto XRPL. It does not mean every institution is adopting XRP. And it certainly doesn't guarantee a future XRP price. What it does show is that institutional tokenization is moving from conference presentations toward actual financial products. That's the structural signal I'm watching. There's another historical lesson here. As security markets expand during the 20th century, physical certificates became increasingly impractical. The industry eventually moved towards centralized and electronic systems for holding and transferring securities. The reason wasn't that paper was philosophically wrong. It was that the scale made the old system increasingly expensive and operational difficult. That's an important lesson for tokenization. Financial infrastructure doesn't usually change because everyone suddenly becomes fascinated with new technology. It changes when the existing architecture becomes too expensive, too slow, too fragmented, or too difficult to scale. Tokenization is attempting something similar. The asset doesn't necessarily need to change. The infrastructure representing the asset changes. This is why I believe we need to zoom out. The real opportunity isn't simply XRP payments. The bigger story is the digitization of financial assets, money market funds, treasuries, bonds, private credit, funds, collateral, settlement assets. Eventually, potentially, almost every financial instrument that can be represented digitally. Let that sink in, that's huge. And if those assets exist on programmable ledgers, the infrastructure underneath financial markets starts changing. The ledger can become the place where issuance happens, ownership is recorded, transfers happen, settlement occurs, and compliance rules can increasingly be integrated into the asset lifecycle. That's a much bigger market than cross-border payments alone. It's huge. And this is exactly why Schwartz's hundreds of billions comment deserves attention. Here's another way to think about it, ladies and gentlemen. The internet didn't become transformative because email was slightly faster than sending a letter. Email was just one application. The bigger transformation was that the underlying communication network became infrastructure for thousands of different activities. Blockchain could follow a similar path in financial markets. Payments may be one application. Tokenized funds could be another. Collateral management could be another. Settlement could be another. Trading could be another. The important question becomes which ledger becomes trusted infrastructure for the financial system. That's the competition. And that's why XRP's ledger, institutional positioning, matters. Now zoom out even further. The Bank for International Settlements and participating financial institutions have been working on Project Agora, exploring tokenized wholesale payments and the interaction between tokenized central bank money and commercial bank money. Recent value testing involved a cross-border transaction of around 1 million across 6 currencies, with settlement occurring in roughly 80 seconds. It doesn't prove the blockchain has replaced the global financial system. It hasn't. Project Agora is still an experimental initiative, but it demonstrates something important. Central banks and major financial institutions are no longer treating tokenization as purely a crypto industry concept. They're investigating the infrastructure themselves. And that's a major shift. This is where I want XRP investors to separate two completely different things. Short-term price action is one thing. Institutional infrastructure development is another. XRP can go up. XRP can go down. The market can ignore a major partnership. A tokenized fund can launch and XRP's price can barely move. That doesn't invalidate the infrastructure thesis, because the question isn't, did XRP pump today? The question is the financial system gradually building infrastructure that will increase the utility of this network? Those are completely different questions, ladies and gentlemen. See short-term noise, long-term structure. And that phrase has become increasingly important in the crypto industry, ladies and gentlemen. Now let's talk about competition, because this isn't an XRP-only story. Ethereum is competing. Solana is competing. Private blockchains are competing. Bank-operated ledgers are competing. Stablecoin infrastructure is competing. Central bank digital currency systems may compete in certain areas. And institutions aren't going to chase a blockchain simply because XRP holders want them to. They will choose infrastructure based on economics, compliance, security, liquidity, interoperability, and regulatory acceptance. That's why Schwartz's comments about auditability are increasingly interesting. The argument is not necessarily XRP's faster, therefore XRP wins. No. The argument is if a ledger's architecture makes institutional verification and reconciliation easier, that creates a different kind of competitive advantage. That's a much stronger institutional argument, but it still has to be proven at scale. There's another development worth watching. The XRP ledger has continued adding functionality intended to make the network more useful for institutional finance. Batch transactions, sponsor fees, confidential token functionality, and broader smart contract capabilities through additional infrastructure. Each of these address a different potential objection. Can institutions manage transaction costs? Can they simplify operations? Can they maintain privacy where necessary? Can they access more sophisticated financial applications? This is how institutional adoption usually develops, not with one giant switch. Eventually, the institutions look at the remaining objections and realize there aren't many reasons left not to test the infrastructure. Then you have the financial market infrastructure developing around XRP itself. ETF products have created regulated market exposure. Institutional disclosures are increasingly giving investors visibility into who is participating. And NASDAQ has pursued standardized options, infrastructure around digital commodity ETF products with XRP included in the relevant framework being discussed. Again, let's be careful. An ETF doesn't mean every institution suddenly wants XRP. No. An option framework doesn't guarantee demand. No. And institutional holdings don't automatically translate into network adoption. But these developments matter because financial infrastructure tends to build in layers. First, you get custody, then regulated products, then market making, then derivatives, then institutional allocation, then potentially broader integration. The infrastructure gets deep. And this brings us to the bigger investment question. What exactly are we watching? We're watching a potential transition from blockchain being an alternative financial technology to blockchain becoming part of the financial system itself. That's a very different story. And XRP is positioned inside one part of that transition. But nobody should confuse positioning with certainty. Ripple still has competition. The XRP ledger still has to attract more assets. Institutions still have regulatory requirements. Tokenization still has liquidity and interoperability challenges. And the market is still figuring out which networks actually capture value from this transition. So the responsible way to view this is not XRP is guaranteed to win. It's XRP as a potential important institutional infrastructure thesis, and the evidence should be monitored over time. And that's the distinction between conviction and blind belief. So let me bring this entire argument together. Number one, David Schwartz's institutional argument isn't primarily about the speed. It's about audibility. The ability to have a shared, continuous, verifiable record can potentially eliminate some of the expensive trust and reconciliation infrastructure that traditional finance has built over decades. Number two, the XRP's ledger's boring design may actually be part of the institutional pitch. Predictability, focused settlement, known transaction behavior, and additionally, functionality that doesn't necessarily require turning the base layer into an everything machine. That's so big. Number three, the institutional tokenization story is becoming tangible. Avia Investors has launched a tokenized share class of the US dollar liquidity fund on XRPL. Project Agora has moved into real value testing, and financial market infrastructure around digital assets continue to develop it. None of this guarantees that XRP becomes the dominant institutional asset, but it does demonstrate that the conversation is moving. And here's the big question I think XRP investors should actually be asking. Not how fast is XRP, not how cheap is that transaction, not even how high could XRP go. No. The bigger question is, what happens if financial institutions begin treating public blockchains as financial record infrastructure? Because if that happens at scale, the opportunity isn't limited to payment. It extends into tokenized assets, collateral, funds, settlement, liquidity, financial markets, and potentially hundreds of billions of dollars of assets. And that is the thesis David Schwartz is pointing towards. And whether the timeline proves accurate is something only the market can determine. I think this is the part that markets is still underestimating. Blockchain doesn't need to replace Wall Street overnight. No. It doesn't need to destroy banks. It doesn't need to eliminate every intermediary, not at all. It simply needs to make certain parts of financial infrastructure more efficient than the systems that came before it. That's how technological transitions actually happen. One process at a time, one institution at a time, one product at a time. And eventually, if the economics work, the old architecture starts looking unnecessarily complicated. That's why I keep coming back to audibility. It's boring. It's technical. It doesn't make for the most exciting headlines. It's like watching paint dry on the wall, ladies and gentlemen. But boring infrastructure can move enormous amounts of money. And that's precisely why Schwartz's comments about hundreds of billions of tokenized assets deserve to be watched. Short-term noise, long-term structure. Prices reacting, systems evolving. And if you're holding XRP, the question isn't simply whether the next candle is green or red. The question is whether the financial system is gradually building a future in which ledgers like XRPL become part of the underlying infrastructure. The story is still being written, ladies and gentlemen, and we're going to keep watching it. If you found this analysis useful, hit that like button. And if you want deeper research into where we think crypto, tokenization, interest rates, liquidity, and the broader financial system are heading, join our Patreon community. We have more than 650 active investors and traders following our research. And every week, we're breaking down the structural change that could matter before they become obvious to the broader markets. The link's in the description. As always, do your own research, understand the risks, and never invest more than you can afford to lose. I'm not here to tell you what you have to buy. I'm here to show you what we're watching. And when it comes to XRP, the thing I'm watching most closely isn't speed anymore. It's institutional infrastructure, because that could be the much bigger story. I hope everyone's having a blessed afternoon. A lot of things to go over real fast. I want to welcome all the new members of the Patreon, the Crypto Public Desk Monthly, all the new members of the membership channel. This might be the most important little rant that I ever do for free, because I'm going to go over right now what I have been telling all the family offices and the families that I was off visiting on business. Unfortunately, I'm not here to make videos all the time. We're always producing content inside the Patreon. So we can't produce videos. If you're missing us, come and see us in the Crypto Public Desk Monthly. This is what I want everyone to understand. And this is probably the most important aspects of this. Focus remains on two things. And this is how you're not going to get cut up like sushi. The U.S.-Iran headlines, U.S. inflation data, oil has stabilized at elevated levels. Brent is holding around $88 to $88.50 per barrel. That has allowed rates and markets to consolidate. But the bid for duration does not look especially convincing, right here, ladies and gentlemen. That's very important. Write that down. The key overnight development is Iran. Iran continues to push back against Trump's claim that the U.S. has total control of Hormuz. Tehran is still linking a fuller opening of the strait to demand being met. For now, this still fits strategic patient scenario, ladies and gentlemen. Negotiations are not really moving forward. Both sides believe time is on their side. Shipping disruptions remain. Markets continue swinging between a deal is close, blah, 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 blah. Talks are completely stuck, get cut up like sushi. But there's a growing risk here, ladies and gentlemen. This may no longer be the clean, benign, taco-style setup the market has become comfortable with. No, it's not. I always talk about we're waiting for the Harry Houdini freak show to end, tweets, blah, blah, blah. Investors have become very comfortable fading oil spikes. They've been selling volatility whenever escalation headlines hit. That's old now, ladies and gentlemen. We've been playing that game for a while. It's old. Stay with me. We're going into the carry trade and XRP right after this. Stay with me here. See, the Houthi factor makes the tail risk more serious. It effectively creates a two choke point problem. Even if Hormuz headlines improve, the Red Sea and alternative shipping routes remain vulnerable. Our baseline remains the same. We are still not expecting a hardline U.S. response, but the risk of a more extreme proxy escalation is high enough that rate markets should not completely ignore the oil sensitivity. Write that down. Now, turning to inflation, CPI came in broadly in line. That gave the front end of the rates market some relief. If you look at core CPI, 0.2% month-over-month gain, headline CPI plus 0.1% month-over-month. What does that mean? 0.1% month-over-month. That means not strong enough to put a September hike back into pricing, but also not weak enough to completely end the debate, ladies and gentlemen. Inflation is still sitting in the uncomfortable middle ground. Too high for the Fed to completely relax, but low enough for the doves to keep pushing back expectation. So next tests are important. PPI, jobless claims, 30-year Treasury auction. My takeaway, I would still be cautious about chasing rallies, ladies and gentlemen. This is how you're going to get cut up like sushi. Don't do it. None of this is financial advice, my opinion, and retains any capacity, especially in the back end of the curve. Supply remains a concern. Fiscal concerns remain. An oil-related term premium is still difficult to dismiss. Here's the bottom line. The market's trying to look through the geopolitical risk. But I don't think we should become too comfortable doing that. We were doing that for a while. We can't do that anymore. Everybody's following now. Oil, inflation, geopolitics, and treasury supply are all interacting here. And that combination could keep rates and volatility much more unstable than the market currently expects. The yen is heading towards a major flashpoint, ladies and gentlemen. I'm going to get into this right now. And let me tell you, this is very, very important. Okay, look, I'm going to go over all this. If you want to understand how to position before what I'm talking about, how to capitalize off of the news, come and join the Crypto Public Desk Monthly. One tip from the pits will pay for your entire year subscription. Join over 650 active traders, investors already taking their destiny into their hands. But this is the most important part because this all ropes in. See, there's financial war going on right now, okay? I spent all week telling family offices and families this. The U.S. is going to try to destroy the Iranian currency. This is what's going to happen. And we are positioning now for this events. If you want to see how to take advantage when the United States begins to do this, come and join us. It's one thing to hear me talk about this, but inside the Crypto Public Desk Monthly, We're giving you every item we're going to play, financial instruments, the price points, levels, everything. But let me tell you what I'm watching right now, and this is important. The Japanese yen is getting dangerously close to the level that could force policymakers back into the market. We're talking about $160 yen to the dollar. The yen traded week as roughly as 159.39 on Tuesday before recovering cycle. And at this point, I'm paying very close attention to that 160 level because we've seen this movie before. We feel intervention is coming. We feel BOJ intervention is coming, and that's going to rock the markets. Taking into consideration that the secretary is looking to destroy the currency of Iran, this sets up for a unique, spectacular, alpha creating scenario. Because every time the yen gets close, there's extreme levels. The question becomes, are Japanese authorities about to intervene again? I think that risk is rising. Remember what just happened. The yen collapsed towards 164 per dollar in late July, getting close to a 4-decade low. Then Japan and the United States stepped in with coordinated intervention, helped pushing the yen back towards 155. That was not a normal or small signal, ladies and gentlemen. That had not happened since 1998. It told the market something very important. Japan does not want to sit back and watch the yen collapse indefinitely. But here's the problem. Intervention can move a currency quickly, but it doesn't magically fix the underlying economics. And that's where I think investors need to focus on. The United States still offers significantly higher interest rates than Japan. The interest rate differential continues to make dollar-denominated assets attractive. Japan also has serious fiscal and energy vulnerabilities, and those factors aren't disappearing because policymakers sell dollars and buy yen. So, in fact, the yen had its worst day since February, falling about 1% on Monday. It's massive. Some of the gains created by that previous intervention are still being unwound. And this is where things get really interesting. So, again, this is not financial advice, just my opinion. If the dollar yen decisively breaks above 160, I would expect intervention speculation to explode. We're in the camp that this is coming, ladies and gentlemen, so we're preparing for this. Listen to me. The market will immediately start asking, when does Japan step in, blah, blah, blah? How aggressively will they respond, blah, blah, blah? And perhaps most importantly, will the United States support them again? But I want to make one thing very clear, crystal clear. I don't think intervention alone is enough to create a sustainable yen bull market. If Japan generally wants a stronger currency, eventually the Bank of Japan is going to have to back the objective with monetary policy. That could mean larger rate hikes. It could mean keeping rates higher for longer, or it could mean both, because ultimately markets care about incentives. See, if investors borrow cheaply in yen and earn significantly higher returns in dollar, the trade is going to remain incredibly powerful. And no amount of jawboning changes that fundamental equation. Here's my view. 160 is the number I'm watching. A clean break above it would be a major warning signal that the previous intervention itself has lost its effectiveness. And if we get there, I wouldn't expect Japanese policymakers to become much more vocal and potentially become much more active. But the bigger question isn't whether Japan can temporarily push the yen higher. The bigger question is whether Japan can actually change the underlying fundamentals that are pushing the yen lower. Because if they can't, every intervention could simply reinforce a temporary reprieve. And that's why I'm watching the dollar yen very closely right now. Because if we see a decisive break above 160, I don't think we should look at that as just another currency market headline, ladies and gentlemen. We're not looking at it like that. We're positioning. I think it could tell us something much bigger about global liquidity, interest rates, commodities, risk assets, and where institutional capital could move next. And that's the part I'm digging into much deep inside the Crypto Public Desk Monthly. Here on YouTube, I can give you the headlines and the bigger picture. Inside the Patreon, I'm tracking the connections between these markets and laying out what I believe these developments could mean for investors and the broader market, what assets are going to take advantage of this, what price levels to take advantage of this. And this is something we can't wait for. So if you want to go beyond the headlines and understand how I'm thinking about these moves and what we're watching next, that's exactly what we're doing inside the Crypto Public Desk Monthly, ladies and gentlemen. The link is below. I'll see you inside. Remember, one good tip in the pit can pay for your entire year subscription. I want you to understand something, ladies and gentlemen. We think that there's a top right now in certain metals. We think there's a top in place for gold, silver, platinum, palladium. Palladium and platinum moved first. Platinum moved higher, and then everything else moved after. But why we're talking intervention? August 12th, August 13th, baby, that was the intervention. The markets flipped the switch. They moved the other direction. Gold took off. Boom. Silver took off. XRP. See, look. They're going to inject liquidity into the market. When they do that, all assets rise. We believe that the financial war in Iran will accelerate when you have someone in there like Mr. Bessett, who is phenomenal with currency trading, made a fortune with the yen back in the day. The man knows what he's doing. I would not bet against these people. So what are we doing as financial mercenaries? We are going to take advantage of every opportunity when the intervention comes to make money off this. We are going to take advantage of every financial opportunity and instrument that will be used to crush the Iranian currency. This is what a financial mercenary does. You feast on the sushi. But again, when this intervention came, the current rally that we saw right now happened. XRP teetering on $1. There's some pain in store, ladies and gentlemen. There's no liquidity in the market. When there's no liquidity in the market, there's no rise in risk assets. That's just the way that it is. We track now when the liquidity injection is coming. So if you ask yourself a big question right now, how long are you willing to hold? If you have no leverage in the market, you Gucci. You don't have to worry about that. If you have leverage trades, you could face some pain. I ask you this right now is because we don't think that the narrative changes right now. I used to tell you about Harry Houdini freak show, death by 1,000 tweets and headlines. That's old news. I spent the whole week talking to family offices and the families and who we were referred to, a new clientele, about how we are able to derive such spectacular returns, extreme, extraordinary performance by locking in on scenarios like this and positioning. So if you want to see how we're going to position for all this, come and join the Crypto Public Desk Monthly. There's so much alpha that's going to be had from this. But again, ladies and gentlemen, I love you all. I'm going to see you on the front lines. None of this is financial advice, just my own opinion and retains any capacity. These videos are made for educational and entertainment purposes only. Always consult your licensed financial advisor before making any investment decision. Never, ever, ever invest a single dollar on watching a YouTube video. Don't ever invest a single dollar from watching a YouTube video, ever. It doesn't matter how many subscribers it has. Don't ever invest a single dollar from watching a YouTube video. Consult your licensed financial advisor. I love you all. I'm going to see you on the front lines. Ladies and gentlemen, if someone asked me on the phone today, how could I time the bottom of an XRP? You got the charters talking about blah, 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 this institution, blah, 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 this line, this indicator, blah, 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 blah. To me, it all means nothing. If someone could read a chart and tell you where things are going to go, why would they tell you? The chart is one story about a financial instrument moves. You're looking for dojis, you're looking for formations, you're looking at all these things. I get it, right? The world we're living in now in finance is driven by headlines. It's driven by liquidity flows. The charts tell you one thing. Anyone who's traded a currency trade in the early 90s, like myself, when the BOJ hits, they hit hard. We're living through a time now where China is trying to create their own financial system and network over there. That is why they are being big buyers of metals. Every time metal spikes, it's spiking in China hours. It's not spiking in U.S. hours. That's why we're watching Asia always. It spikes over there. They physically need this stuff. They gobble it up. They gobble that stuff up. Boom. We hit back. Intervention. Boom. These create tidal waves of liquidity flows that we capitalize and we wait. We wait for them. And when you wait for them and you know what to play, that's all that it takes, ladies and gentlemen. But as the world changes, we have to adapt. The old saying, nothing changes if nothing changes. I love you all, ladies and gentlemen. I'll see you on the front lines.